Hey everyone, it is Evan here from the Trade Risk on Friday, June 21st, here with a weekend market recap video. We're going to cover all of the major markets, the current market environment, and finish off looking at some sector analysis. So jumping into our market technicals dashboard, we had a big week this week with new highs for the S&P 500 following the much anticipated two-day Fed meeting with rates being left unchanged. We could see Friday we did close down to close out the week right across the board, but that was after a strong run. You can see the 5-day change numbers all firmly positive from the major indices. We are above all of the key moving averages here across all the major indices. We are above last week's highs, and when we scroll down a bit here, we have some good risk sectors here leading. We have biotech at the top, energy, semiconductors leading the charge on the outperformers. On the downside, we have staples, materials, financials, and utilities, all about break even over the past 5 days. For major markets, we got oil up in front, really big move this week, 9.28%. If we look all the way at the bottom here, we have its counterpart here, natural gas, which was down almost as much as oil was up, making new year-to-date lows. And on the upside here, we also had China and gold. On the downside, volatility and the US dollar. Now, one thing to note, and this is not picking up here either, the S&P 500 did go ex-dividend on Friday. So again, if you're looking at those spider charts, just be aware, if you looked at the day on Friday, it looks like we closed down 63 bips. But if we look at the cash market, you can see we in fact closed green here on Friday. We closed off of the highs, but we did close positive. So the SPY ETF is skewed a little bit lower, probably about $1 or so to the downside because of that dividend. Now let's go to the weekly time frame. We like to start our analysis here. So this is the S&P 500. This is the cash market, and you can see with the progress we made this week, 2.44% to the upside, closing at new weekly highs for the S&P 500, taking out the old 2945. Let's see, what was it? 2954, in fact, was the prior high here back from the 3rd of May. So good news for the bulls as we break out here to new all-time highs. Again, MACD now getting a little bit weaker as we continue to break out. Now, one thing to note, if you've ever studied kind of momentum here in the MACD and oscillators like this, you tend to get momentum peaking before price actually peaks. So again, we do have a little bit of divergence now setting up here as the market continues to rally, or if it continues to rally here to new all-time highs or continue to trend at new highs, we will have this, which will slowly start to, potentially impact things or creep into the analysis as we ratchet higher and higher. But for now, I don't think that this is a warning, all must fail type of signal by any stretch. I think we certainly can continue higher. I think the momentum in the short term, which again is why timeframes are so important, is very strong right now behind the S&P 500. This is the daily chart. You can see the MACD rising to the highest levels it's seen in many months, possibly all year. A little bit earlier in this year was a little bit higher, but still you can see firmly positive territory leading as price breaks out here on the daily chart. So time frame is important. It is notable here on the weekly chart. We'll continue to monitor it, but right now with no overhead resistance, no overhead supply, it looks pretty good here for the bull case. So going forward, we're going to see if we can just hold on and maintain these highs. If we saw some abrupt reversal next week, some high volume rejection of these highs and a failure back below 2950, then that would be, at least short-term concerning. But for now, bulls getting it done, marching higher, putting in consecutive continuation weeks here, and really lifting to those all-time highs. Now, the daily chart, which we just looked at, here it is again. You can see we basically broke out on Tuesday of this week from the consolidation we saw last week. So we had that high tight consolidation. We broke out on Tuesday, and we pretty much marched higher throughout the rest of the week. Now, it's important to note here is just look how fast this move has all sort of manifested, right? We were in the series of this 5-week pullback here throughout the whole month of May, and it was just kind of this grind lower, and it was kind of putting a damper on sentiment, if you will, as the market pulled back. And look how quickly we recovered all of this pullback in just 2 weeks' time. We had this very sharp move which was 2 weeks ago, which we rallied about 5.5% off of the lows. And then we put in this consolidation. We basically gave nothing back in terms of a pullback through price. We didn't come all the way back down into the midpoint of the range. We didn't retest recent lows. We didn't come back down and test 2,800. We simply just went sideways here, very, very tight, and just holding up in the upper end of that latest push higher. And then that ended up being the push and breakout here this week, which led to new highs. So the market, really, when you look at it over the past 3 weeks, it's really been in a chase mode here. If you weren't a believer, if you were kind of on the sidelines back here, and certainly, if you're a technician, for deservingly so, as you start to pull back here, you're probably taking a sideline view and just waiting for strength to renew. But the point is once strength came, it kept coming. It was relentless, and then now we're quickly back at all-time highs in the matter of a blinking eye. So the point is that the chase here, the momentum is strong right now. If you want to get back in this market, you have to pay up. And the S&P 500, this chart here is showing exactly that. Basically, the chase is on as we start to ratchet ourselves back to new all-time highs. Now, the IWM and other indices, they're not quite back at prior highs. In fact, they're still kind of stuck in the range. I'm looking at the IWM here, and you can see it was a positive week. It was 1.43% to the upside, but still you can see there is still a good lag going on here for the Russell 2000. We are still stuck inside this sideways range, which we've been in for basically all of this year. Since February, we topped out around under 160. We've tested 160 a couple of times. We've failed, and we're kind of just meandering sideways here, lost in the middle of a range. And it looks, it looks like anybody's guess. The bulls in the short term do have the trend in their favor. It still seems likely or reasonable that we can get back up to the top end of this range and test things in the coming weeks, but we need to see if that actually happens. We need to see if bulls can continue that strength, and then of course seeing how it reacts up here around 159 or so. That's going to be the big question heading into the summer months if we get back up there. Until then, we can look at the shorter term trend that's basically been in place. We're kind of testing it already based on the close here on Friday. You can see we closed pretty much near the lows, and the next sideways kind of horizontal level that's relevant in my eyes would be this 151.50 area. So the S&P 500, nice rosy bright picture there for the bulls. Here, a little bit more neutral for the Russell 2000. Again, if you zoom out here, whenever you're in doubt and you just need to kind of zoom out, or whenever you're in doubt, I think zooming out is certainly a good way to sort of get the bigger picture and perspective here. And again, you can still see it's kind of messy here. It is still holding on to the majority of the first quarter's gains. So in the very kind of short to moderate term, as long as we're holding above the 150, 145, 146 area, it's tough to get too bearish. But if this continues to diverge, if this starts to roll over, if momentum grows to the downside, if volume picks up to the downside, those are all going to be clues that we have some other issues going on in this market. So at best, I would say right now, the Russell just needs some more time, and maybe this is a second half story. Maybe, in the tail end of 2019, the Russell 2000 plays catch up. It helps push the market into the year end. Again, all projections and speculation, but just some thoughts here as this meanders sideways in this range. Now, the NASDAQ 100, if we look at this, you can see not quite back making new all-time highs, but certainly a good effort getting really close back to the 191 highs. It's basically 1 day's range worth away from printing new all-time highs. If we look at the weekly chart here again, you can see the story of a very sharp move that has really unlocked itself to the upside really quick, really helping kind of put the chase on here and marching back to those prior highs. So the NASDAQ, the Dow Jones too, which we don't usually cover just in terms of kind of redundancy, but the Dow Jones almost got new all-time closing highs on a daily basis. It looks like it pulled back enough where it's not, but really close, really, at the top end of this range. It's taking out the highs here from April of this year, but it looks like we're still below the highs here from 2018. Although if we looked at the total return, it'd probably be pretty close. I'd have to look at it. Let's see, total looks like we're close, but not quite all-time highs for the Dow Jones either. So that's the scoop. Bulls really running away from it this week. Again, maybe frothy in the short term, but let's not get too overly analytical about the very, very short term and keep the bigger picture in mind. And right now, equity prices are moving higher. Now, we had that pattern of equities moving higher. We had bonds moving higher. We had the dollar moving higher. We had gold moving higher. And we started to get a falter in two of those things this week. Sort of a minor falter is the TLT here. It looks tired. It did have a pretty good tail as it tried to push to new highs this week, and then it pulled off of them and closed near the lows. It was very much flat here on the week, but you can see on the daily chart, it tried to push up. It failed pretty convincingly here on Friday, giving us kind of a short-term sell signal, if you will, higher volume, a little bit of momentum divergence there to the negative side. So kind of setting up for perhaps a move back down to the 130s, even, into the mid 120s. This has had a really strong run, so a more of a reset back down into the mid 120s would not be unreasonable at this point. But again, there's still kind of better things in my eyes that I would want to be shorting than this, but to each their own. It looks like if you're tactical here, you had some opportunity, maybe you get a couple of points down to the trading lower here. But TLT, I would say, looks tired, still holding the upward trend. So again, I don't want to be too overly bearish here or critical about this market, but it just really depends on your time frame and how active you want to address this. So TLT, that's a little bit of faltering this week. And the dollar. The dollar here on the weekly basis, you can see rolling over 1.37%, kind of, after hitting this, this is the dollar index, of course. But as it kind of tagged this 2640 area, kind of rolled over a bit there, and certainly got this gap down and kind of a heavier volume move to the downside. So that was those were the two that kind of started to diverge this week: bonds and the dollar. Equity prices rose, and gold prices. This is the big story. This is where all the headlines, the newsletters, the newspapers, all the emails will go out this week saying gold is breaking out here, having a big week above multi-month or multi-year resistance. And in fact, I think it's warranted. I think we should be talking about gold. I don't think there's anything wrong about it. I think we should be, kind of looking at this and saying this is a pretty significant area here. 1360 in the spot gold price per ounce. That was the big resistance that we wanted to take out. We took that out, and we closed the week close to about 1400, just under the 1400 mark here for GLD. And I do think that this is pretty technically significant. There are a lot of eyes on it, but I'm not as concerned that there, in the short term, maybe there's a little, some back and filling and a little bit of a kind of a shakeout to be had. But given the fact that this has been effectively gone nowhere for the past 6 years, this base and in this range here and the fuel that's kind of primed here for GLD is really got a good set, a good scene set to outperform and to continue to rally higher. So I like GLD. I like the breakout here. I liked it, last week we talked about it, even in here as it was holding up, the good volume that came in. We sort of liked, we liked what gold was showing us here, and it continues to show us some pretty nice things. It's a big move for the metal. Certainly, it's a tough chase here, but time frame is going to be important. So you have to keep that in mind. But gold getting a nice lift off this week to new multi-year highs. Now, if we look at silver, silver was what we've been waiting for to play catch up. In fact, we took a position in silver this week. We took it on Fed Day, about $14, under $14.10. We put it on, I think $14.09 was the exact entry where we got involved in the SLV ETF. So down here, it had a nice move into the end of the week. Again, we're looking at silver to play some catch up here on this metals trade. For the specific trade that we put on, we were talking about silver at this $14 area, as this was an important zone back in 2018. That was the top end of the range. We broke out of it late in the year. We held above it, then we kind of grinded back below it. We had basically got a move back over 14. We got some nice positive momentum divergence over here. We had volume picking up ahead ahead of this, ahead of the late day surge or the late week surge. So there are lots of little signs here. We put the position on, we still hold it, and we're going to see if this can continue to work itself higher. It seems like there's plenty of room to move back up into the upper end of this range here to the upper to mid 14s, even 15s. It wouldn't be unreasonable here, especially if it wants to play some catch up and continue to work itself higher. So we'll see if that can work. But for now, we're long silver and we're looking for higher prices. Last but not least is we have commodities oil. 9% move, 9.5% move this week. Very big move, very heavy volume coming in here. Heaviest volume week all year long, and it broke back above here to the $12 area. That looks constructive. Again, it's coming back into some overhead supply now where it started to gap down and have prior supply trading at from this year. So it is going to be a bit of a tougher chase now at these levels than a couple of days ago. But right now, short-term momentum is to the upside. For me, there's just nothing here. If you weren't in it back from here, then it's sort of a tough chase in my eyes. But based on how I trade, that's the way I look at it. So I'm just kind of avoiding that. And all of the gains in oil seem to be the losses for natural gas as this breaks to new year-to-date lows. And on the weekly chart, this was down 8.5%. So really kind of getting a washout here. Again, volume picking up, well, particularly on yesterday, on Thursday's session, looked like the heaviest volume we had all year. Let's see, maybe not, but certainly in the top couple of days volume we've had all year, and it is quite extended to the downside. So if you're kind of bottom fishing, if you're tactical, if you're active, if you know how to manage risk, maybe there's opportunity there in the very short term, but still all the trends for natural gas point lower at this time. So that is all of the major markets. Let's look here at some of the sectors now. Top performing and bottom performing sectors. Top performing sectors, we had XBI. So XBI here is biotech. This is the smaller cap, kind of equal weighted biotech. We do have a position in this. Once again, we've been trading in and out of this. We originally picked some up here back on the 4th. We had a quick trade. We sold kind of at the upper end of this range. And then we put some back on here on Monday of this week. I believe Monday was the fill. Yeah, it was Monday of this week, right around 83, is right near the open. We put some on XBI. We already sold a piece into this 87 and change area. We sold a third. So we still do have 2/3 of this XBI position on, looking to hold it for a bigger move. Still like the action here. I like this breakout of this range. Talked about the momentum divergence here. Mentioned this many times in the videos that we've been doing. So XBI, it's a current long hold. Took some profits, trailing up a stop, and we're looking for higher prices. In fact, all the way to the 90s. We'll see if we can actually get them. So XBI, I like it. A little bit of a chase now, but we do own it. IBB, this was number 2 here. Again, very similar picture. This is biotech again. You're just looking at larger cap names. Could have played this as well. Had very similar characteristics to XBI. I just liked the way XBI set up a little bit better here. But you can see again working itself back above the range here that it spent the first 4 months of this year in. So I like it as long as it can kind of continue to hold up there. It does the job at working itself higher. Semiconductors here, looks like it's trying to bottom out here. It had this pretty strong move to the downside. It had 20% correction here in May. It looks like it's trying to find a bottom here. MACD is leading, so I'm more optimistic here. Again, it needs to hold ideally above $100, but for now, I think I think there could be some names in play there. Looking at a few for some trade setups ourselves. On the downside, we had staples. Really, not much to say about downside, considering it's trading just under its all-time highs. It's enjoyed a good move. It's a lower beta play when the market's hot. We're moving into more riskier assets. The staples a little bit slower here. So for me, the trend is up. I mean, it's just a function of it working pretty well over the past couple of weeks, and now it's just taking a quick pause. Materials, pretty much the same thing. Again, this volume is really hard to ignore here. This is generally not something that is happening at the end of a move with this type of especially after a sell-off, that type of volume getting put in here. I like materials. I think this is indicative of something that will work itself higher over the next weeks and months. It certainly could use a pause here, even a pullback in price. But look at this consolidation right now that's taking place. Very, very, very low volume after this, 3x, consecutive 4-day volume. This to me looks pretty bullish here, and I'd be paying attention to that sector. Financials, kind of flat here on the week as well. Again, it's kind of holding sideways. It's holding up. There's just better plays out there. I don't necessarily hate financials here. In fact, I think they could ultimately lift higher here and continue to work up above this range. As long as it's above $26, I don't think it's reasonable to be too bearish here. But they're just again, it's when there's lots of things working, there's just some better spots than financials right now. But I don't dislike them at this point by any big stretch. So that's it. That's what I got for this week. Lots of movement, lots going on here, but equity bulls, gold bulls getting rewarded this week. Bonds maybe cooling off a little bit, but lots to kind of chew on as we pull into the summer months. We'll see how this market deals with some of the lighter volume and historically elevated volatility. We'll see if it creeps in. Right now, volatility is coming to the upside. So that is it for me. Thank you so much for tuning in and watching. As always, you can subscribe on our YouTube channel, follow us on The Trade Risk. Have a great weekend, and we'll talk to you next week.